On a late summer morning, the financial markets began to stir with an energy that felt both restless and uneasy. Screens across trading floors lit up with new data, and the numbers that appeared carried a weight that could not easily be ignored. Employment figures suggested resilience, pointing to businesses that were still hiring and workers who were still finding opportunities. For many, it looked like proof that the economy had not yet surrendered to the pressures that were building quietly beneath the surface. Yet inflation remained unmoved, refusing to show signs of retreat. Prices continued pressing upward, a stubborn reminder that growth on one side of the ledger was being tested by the erosion of purchasing power on the other. Balance felt elusive and fragile. Investors, policymakers, and households all found themselves bracing for what seemed like an inevitable confrontation. The tension between growth and restraint was no longer theoretical. It was shaping choices in real time, and the outcome promised to ripple far beyond the walls of trading floors. At the center of this looming storm stood the Federal Reserve, burdened with choices shaping ordinary lives. Would it safeguard jobs, nurturing momentum for workers, or deliver harsher medicine to tame runaway prices? That decision carries immense weight, echoing across households, paychecks, mortgages, and the nation's fragile economic future. Dr. Eliza Martinez at the Brookings Institution explained to Truthory that the Fed always walks a tightrope. Its mandate is a duel between jobs and prices. She warned that whichever side the Fed leans toward, the cost will ripple through markets and families alike. Fresh labor data shows the United States added 250,000 jobs in July. Wages climbed 4.2% compared to last year. But inflation, especially core inflation, stubbornly sat near 4%. Growth looked healthy on paper, yet inflation stalked quietly, like an uninvited guest at dinner. Dr. Jonathan Lee from the New York Fed told us during a call that this is not the 1970s. Demand remains strong, but costs refuse to soften. His words carried weight, hinting the Fed may lean hard against inflation even while employment continues to shine. On Wall Street, the whispers grew into a steady hum that traders could no longer ignore. Screens glowed with red and green, futures shifting with every rumor. By noon, markets placed 65% odds on a September hike, and patience suddenly felt expensive. That is money voting against calm deliberation, against waiting for more data. It is capital betting that inflation still burns beneath the surface, hotter than official numbers suggest. Markets rarely lie outright. They hint, they nudge, and they warn through prices. This time, warnings felt unmistakable. At a corner cafe near Broad Street, an analyst named Rebecca scrolled through her terminal between sips of burnt coffee. She remembered last autumn, when payroll gains looked strong, yet her rent rose faster than her paycheck. Charts were one thing, groceries told another story. For Rebecca, the market odds were not abstract. They were rent checks mailed late, friends postponing weddings, and colleagues whispering about second jobs. Futures contracts weren't just speculation. They reflected whether ordinary people could fill their gas tanks or buy bread without calculating sacrifices. So when traders priced in pain, Rebecca understood the translation. Inflation had not been defeated, no matter what payrolls shouted. The Fed's September decision would not unfold on paper alone. It would land in kitchens, wallets, and commutes and all other real places where economic theory meets human survival. Stephanie Birch, a veteran fund manager, told Truthory something blunt. If rates stay high too long, jobs may vanish. But if inflation is ignored, families watch grocery bills devour paychecks. Her words sliced through the noise. The choice, she warned, is survival against survival. When the Federal Reserve chooses inflation over jobs, it is like a household cutting expenses harshly to tame runaway bills. Imagine skipping family dinners out, canceling streaming services, and tightening every corner. The short term feels painful, but unchecked spending would have bankrupted the household entirely. On the other hand, if the Fed chooses jobs over inflation, the situation is like parents buying expensive gifts for their children to keep smiles alive, while credit card debt quietly balloons. Everyone feels happy today, but tomorrow the crushing bills turn joy into panic. Both examples show the same truth. Choosing only jobs risks debts and higher costs that destroy purchasing power. Choosing only inflation risks layoffs that erode security. The Fed is not playing a classroom game. It is juggling choices that echo in kitchen tables nationwide. This matters because your mortgage, your rent, your grocery bills, and your retirement savings all move with these decisions. The Fed's policy is not abstract finance. It dictates how much of your paycheck survives and how stable your future truly feels. So, you see, the Federal Reserve is not resolving abstract theory in a quiet classroom. Its decisions ripple through grocery aisles, fuel stations, and monthly mortgage bills. It is determining how much bread truly costs, how debts are managed, and whether households find room to finally breathe easier. Minutes from the latest Federal Reserve meeting revealed a stage filled with tension. Some policymakers spoke with caution, fearing that aggressive action might wound the fragile labor market and leave countless workers vulnerable. Others, more hawkish, insisted that inflation left unchecked could destabilize expectations for years, eroding hard-earned stability. We spoke with Carmen Reinhart, a leading economist, who said that central banks cannot afford to lose credibility. If the public begins expecting higher prices, the psychology itself creates inflation. Her voice carried urgency. She warned us that delay now could prove catastrophic tomorrow. Investors do not wait for poetry. They respond to fear. The yield on the 10-year Treasury jumped above 4% right after the jobs report. Stocks staggered. Bonds demanded more return. The message was clear. Inflation is not finished, and the markets know it. Meanwhile, the small players feel the sting too. A cafe owner in Des Moines told us wages for staff went up 6%, but customers already complain about prices. She cannot raise them further. That story of one cafe mirrors the entire national dilemma perfectly. September now looms with heavy silence. Will the Fed pause, hike, or pivot? Every hedge fund desk, every small business, every saver is waiting. These decisions are not just announced. They are traded, debated, and felt. The outcome will echo far beyond press conferences. If the Fed picks jobs first, it risks letting inflation spiral again. Think of it like turning on the heater full blast in winter. Everyone feels cozy, but the electric bill doubles. Comfort today creates a bigger problem tomorrow when costs demand painful sacrifice. Now picture if the Fed crushes inflation instead. It is like slamming the brakes on a speeding car. You avoid the crash, but passengers get jolted. Businesses stop hiring, projects freeze, and suddenly layoffs rise. The pain comes differently, but it strikes with equal weight. Neither path is painless, and this is where ordinary families feel it most. Every extra interest rate point makes mortgages harder to afford, credit cards heavier to pay down, and auto loans tougher to secure. The Fed's language may be technical, but the consequences breathe everywhere. For example, a family buying their first home could watch monthly payments swell by hundreds of dollars just from a small rate hike. Another family relying on small business credit might see banks tighten lending, stalling dreams. Fed policy is not abstract. It walks into households directly. This is why it matters. The Fed's choice between jobs or inflation decides whether people feel secure in their paychecks or anxious about their debts. It is not a debate in academic halls. It is a decision about who bends and who breaks in daily life. Jerome Powell himself has admitted this tension is real. In April, he told the Economic Club of Chicago that our dual-mandate goals can sometimes come into conflict. Translation: even the Fed chair concedes that fighting inflation might cost jobs, and saving jobs might reignite inflation's fire. History has a way of whispering lessons to those willing to listen. In the 1990s, the Federal Reserve raised rates boldly, and that firmness kept inflation in check without breaking the backbone of job growth. Decisive action bought stability, and confidence spread across households nationwide. However, the 1970s tell a darker story. Leaders hesitated, fearing the pain of tighter policy. That pause allowed inflation to run wild. The result was chaos, rising costs, shrinking paychecks, and a generation burdened by relentless economic uncertainty. That is why timing matters more than any ideology. The Fed today must weigh not just charts but human lives, where every grocery bill and mortgage payment counts. Delay could invite regret tomorrow, while steady, firm action may safeguard prosperity for countless families. Picture this. A worker finds a job easily, but when they shop, their paycheck buys less every week. That paradox of jobs plentiful but power evaporating is the Federal Reserve's nightmare. Every rate change either strengthens that worker's future or weakens it further. Truthory's insight is simple. The Fed's coming statement is more than technical guidance. It is a declaration of priorities. Will they lean toward protecting paychecks or protecting the dollar's strength? In this choice, the fate of families and markets is written. Therefore, if the Fed miscalculates, the cost is severe. A deflation spiral would choke credit. An inflation scar would erode confidence in American institutions. Money is not just numbers on a screen. It is belief in stability, and the Fed is guardian of that belief. In short, the choice is not abstract. It decides whether your wallets feel heavy or light, whether the markets sleep easy or tremble. Truthory will stay with this story because the stakes are not theory, they are survival. So what do you think? Will the Fed pick jobs or inflation?